always love when news happens and I get to ask you about it at these conferences. And this news is actually an activist investor, but a little bit reversed. It's Strive Asset Management is now being called the anti-ESG activist investor, basically saying get rid of the ESG promoting shareholder-friendly attitudes and just pump more oil. What do you think about something like that right now?
Well, we just received a letter from Strive yesterday. I've had a chance to go through it, and look, we have investors with points of view on all aspects of our business, and certainly they've put forward some strong opinions on some things. We engage with all of our shareholders and look forward to doing the same with Strive to understand better what they think, and it always helps inform us and make us better.
What I do, though, find interesting is that it comes at a time when Europe and the questions there on energy is, can you have energy security and green goals at the same time? And that's why I find it interesting about this activist investor right now.
Well, Alex, one of the things I've been trying to call for is a more balanced and pragmatic conversation about energy. There are three things that really matter when it comes to energy: affordability, because that underpins economic prosperity. Energy security, because energy security equals national security, and protecting the environment. And we have to have a conversation that recognizes all three of these. And in different parts of the world, the balance among them may be different, but you can't over-index on just one of those and really have a stable and sustainable system going forward. And so I think that's an important conversation to have. Engagements with people that have these points of view help us have that more balanced conversation.
To that point, and staying in Europe for a moment, obviously LNG, Europe needs it very badly. How are some of the ways that Chevron can help deliver that LNG? You recently signed a deal in June to buy some LNG from Venture Global and Cheniere. What else are you looking at?
Well, we signed a couple of deals to bring gas that we produce in the U.S. Through liquefaction facilities and move that to Europe. We currently supply LNG to Europe from West Africa, Angola, Equatorial Guinea. And we have a position that came to us with the Noble Energy acquisition in the water offshore Israel in the Eastern Mediterranean, which currently only supplies regional markets in the Middle East. We're working on potential expansion investments there that could also provide liquefied natural gas supply into Europe. So a number of different opportunities we're advancing.
What else are you looking forward to now in that sense? Any other opportunities, joint ventures, bolt-ons, anything else that's in the pipeline in relation to that?
In relation to LNG? Mm-hmm. Well, our operations in Australia primarily supply Asia, although some of those flows can be redirected if Asia can switch to different sources of fuel for their power system. And so we're working with our customers in Asia, and we have discretionary cargoes as well that we can feed into Europe from Australia.
How do you see the M&A market evolving in the energy space for LNG or for oil or nat gas? EQT made an enormous acquisition, $5.2 billion in the Marcellus. How do you see the world right now from your lens when it comes to mergers and acquisitions in energy?
Well, commodity prices have cycled back up, which allows all companies, I think, to relieve some of the pressure they were feeling through the depths of the pandemic. They can think about transactions as opposed to just survival. A deal like the one we just saw with EQT, which consolidates a position in a basin where they're very strong and provides real synergies, operational synergies, and corporate synergies, makes sense. We've seen deals like this in the DJ Basin, in the Permian. We could see more of that activity as we go forward.
What's so interesting, though, if you take a look at the price, though, for oil, for example, we have OPEC cutting production and oil prices are down 6% in 2 days. What is up with the oil market right now?
Well, I think in the near term, markets are factoring in the prospects of recession. Certainly the situation in Europe as winter comes. We're seeing monetary tightening in the U.S. and some economic slowing in the U.S. And of course, China has a lot of their economy under various COVID restrictions right now. So in general, I think there's a concern that demand growth may be softening. And I think we're seeing that weigh on commodity markets in the near term. I think in the longer term, we continue to need to focus on the supply side of the equation as we come through the next few months. Will there be sufficient supplies to meet demand as we move into next year?
So I love that you bring that up, because I feel like the conversation 6 months ago was the world needs more U.S. oil in 2023 and the U.S. has to produce it. Is that still the conversation when we have these recession concerns?
Well, in our business, we have to look through near-term cycles. It's a long-term business. Our company's been around for 143 years.
The U.S. can be short cycle, so.
Well, we've got short cycle production that is short cycle from, drilling the well to bring the production on, but then that production's in the market for the long term. And so we really look through these economic cycles to long-term fundamentals. I think the U.S. is an important supplier of energy. It's the largest exporter of oil, of LNG, of products into the world. And at a time when the world is tight, it's important that U.S. supplies not only meet domestic needs, but also support international markets and customers.
So do you think we're going to need more U.S. oil next year?
I think we'll see more U.S. oil next year. Okay. We're certainly seeing growth this year. We're growing, 800,000 barrels a year likely. Over the course of this year, we'll finish somewhere in the neighborhood of 12 million barrels a year, not far off of all-time highs. I think you'll see that growth continue into next year. Certainly, our production in the U.S. is up 7% first half of this year versus first half of last year. We intend to grow our Permian position from 700,000 barrels a day today to 1 million barrels a day in 2025. So that means we'll grow next year and the year after and the year after that.
Speaking of, when we spoke a few months ago, we were talking about your cost profile for 2023. Have you have any more visibility into what those costs will look like in 2023? And does that slow your ability to grow U.S. production in any way?
I don't have a final view into 2023 because we're in our final business planning process right now, but we tend to plan our work well in advance. We're managing this year's inflationary pressures very well. We had anticipated a certain amount of inflation. We work closely with our service providers and suppliers to give them visibility into the work we have out ahead, and I would expect that we'll continue to see some upward pressure in the coming year, but something that we can manage that wouldn't change our...
single-digit kind of thing?
Yeah, what we're seeing right now is probably mid to high single digits, and we can manage that within our overall budget. It won't drive budgets outside of our guidance range.
Let's talk about managing in terms of buybacks. So if I get this right, on an annualized basis for the third quarter, you're already at $15 billion on buybacks for an annualized rate. And I'm wondering, can I interpret that to be the standard going forward? Like that's going to be the thing, 15 billion buybacks?
Well, we've set a range of between 5 and 15.
Sure, but is it really going to be 15?
Well, in this environment, 15 is where we are. I would expect us to continue at that rate. We've got strong cash flows. We've got a very disciplined capital program. The balance sheet is, frankly, probably under-levered, and we intend to sustain our buyback through the down cycles and the up cycles, not be in the market only when conditions are strong. So we're at $15 billion until advised otherwise.
Mike, it's David Westin back here in the studio. Thanks so much for being with us. Whatever your plans are, and I understand they're long-range plans, is there anything Washington could do that would make a difference one way or the other? We heard from President Biden that you all should be pumping more, that it's up to you CEOs, because you're not pumping as much. We hear from people on the other side that, in fact, there's a lot of restrictions that could be lifted. What's your perspective?
Well, David, there are mixed messages. And look, the industry is responding to market signals. We're seeing production grow strongly in the U.S. this year. We're coming out of a very sharp downturn through the pandemic. There are very real constraints on services and the capacity to support growth efforts. And as I mentioned, our growth is up strongly year on year, 7% in oil production, 10% in refined product production versus first half of last year. Our spending, including an acquisition that we did, is up 80% over first half of the year before. So we're doing our part. But the mixed messages that we get out of policymakers do make it challenging to invest. The one thing that I think is very important that I'm hopeful for is that we see substantive and meaningful reform to permitting in this country that enables us to build infrastructure not only in our industry, but power transmission infrastructure, renewable power generation. It's difficult to permit infrastructure in this country of any type, and to build it in substantive reform would be a very meaningful step forward.
Exactly, Mike, which takes me to my question, which is, as you know, as part of that Infrastructure Reduction Act, there was an agreement made with the West Virginia Senator, Joe Manchin, basically for a bill to be put forward this fall to reform some of the permitting. As far as you know, with that bill, would that make a material difference in Chevron's plans?
Well, we haven't seen proposed legislative language, so it would be speculating on something that I really haven't seen. What I would say is if we had material reform, what it would do is it would send a signal to the industry to invest in infrastructure, to invest in production with the confidence that we actually could execute those investments. And so I think it would be a very positive signal. I can't tell you how it would impact our plans until I see some specific language.